Hey, Brandon, are you here? Or he's not going to try to do this one alone, is he? I mean, the last time he did one alone, he made, a couple of little errors. And if Brandon, if you had been here, you could have corrected him. Now you can't be sure what's going to happen. But, oh, here he comes. I'm going to hide. Bye-bye. Hello, everybody, and welcome to Innovative Charitable Planning Techniques. I'm Alan Gassman. I'm going to talk for about 40 minutes, which is probably all you can stand. And then after that, I'm going to play a videotape that Brandon was kind enough to produce on charitable remainder trusts. And the thing about charitable planning is that you do wonderful things for people, for animals, for the environment. It's appreciated, and Uncle Sam kicks in and pays for part of it by reducing your tax bill. The bad part about innovative charitable planning is that this is really complicated stuff. And like many of my colleagues, I don't have the luxury of doing this type of work 10 hours a week. If I did this work 10 hours a week, I would know it inside out. But if I only do it 2 to 3 hours a week, it takes a lot of investigation to determine how things work as to a particular client. And that's why we will regularly go to lawyers who do charitable giving work 30 to 40 to 50 hours a week. They have the knowledge, but for some reason, they don't write the books. So there is a shortage of literature, and there's also a tendency to not want to be so loud about things that work that the government may not like a lot if they become highly popular and known. So the purpose of this presentation is to assist advisors and to assist bright and affluent taxpayers in understanding that there are many, many different ways to pursue and complete charitable objectives while avoiding and reducing both income and estate taxes. The other thing I want to say to everybody on this webinar is that there are times and seasons in people's lives where they become more or less charitable. And as a tax advisor, in my case, as a tax lawyer and estate planner, the question as to whether a client would like to do something charitable while they're alive or after death or a combination thereof should be, I would say, politely and gently asked anytime there's an interaction, because people's intentions change and their generosity changes and what they want for their descendants changes. And sometimes the best thing you can do for your descendants is to get them involved in charitable organizations and charitable purposes so that they can understand how fortunate they are that they have things that other people are not able to ever have. Now, some shameless self-promotion first. Please sign up to receive our Thursday report. You can just send me an email at info@gassmanpa.com. It is a free report. It goes out every other Thursday, maybe not. Sometimes we run late, comes out Friday. But this Thursday, we had an article on charitable planning for real estate investors and developers. This is the introduction to a talk that I'm giving for next week for the Sidney Kess United Jewish Appeal Tax and Estate Planning Conference. And I really recommend that conference. It's one of the best in the country. It's only $195 for 2 days of really good programming. 3 hours of the programming are charitable oriented. Jerry Hesh is going to talk about innovative tax planning for real estate. So thank you for being part of my guinea pig group for sort of rehearsing some of the material that I'm going to use for that presentation. And next Wednesday, Chris and Brandon are going to be talking at the Notre Dame Institute for Jerry on slats, and I'll be speaking with Jonathan Blottmacher on Friday on reducing estate planning litigation risks, which is an interesting topic. Anything you do with Jonathan Blottmacher is going to be an interesting topic. It could be on how to take white bread out of a bread bag, and it would be interesting if Jonathan explained it. So please feel free to join us at any of these presentations. Now, page 13 is a chart that talks about the various rules of charitable giving. And at the bottom left-hand side, every taxpayer can deduct up to $300 in donations. So one question is whether you have gifted $300 to all of your grandchildren, your great-grandchildren, your nieces and your nephews, explaining to them that you would like for them to make charitable contributions and they'll get a tax deduction. So you give them $300, they give $300, and maybe they save $100 in taxes. But it's a nice thing to do for people who do not itemize their deductions. So the itemization of deductions is here under number 4. A single person who itemizes needs more than $12,550 of deductions for property taxes and charitable donations in order to be able to deduct more than $12,550. Now, you can only use up to $10,000 of your property tax bill towards that. So if your property taxes are going to be deductible up to $10,000 and your charitable donations are going to be $2,000, you're not going to get an extra deduction for your charitable donation of $2,000. But if your property taxes are $10,000 and you give another $10,000 to charity, then you're going to get an extra deduction of $20,000 minus $12,550, which is $7,450. So what you could do is donate $10,000 to a donor advised fund like the Schwab Donor Advised Fund, and then get that tax deduction. You'll save maybe $2,000, $3,000 in taxes, and then dole that $10,000 out over the next few years. So you get the deduction now for what you know you're going to donate over the next 5 or 10 years. And I like that idea. And what I find is once we do that, I explained to Marcia, we're going to save $2,500 if we put 10 in. Okay, great. Well, now we have the 10 in. Well, you know, I would really like to donate a little bit more here or there, and it's already in the Schwab fund. It really doesn't cost us anything. So the psychology there is very nice. Now, for a married couple, your itemized deduction is $25,100, and you're limited to $10,000 in property in your taxes. So you might make a $30,000 donation or a $40,000 donation. Or the other thing you could do is save up. So that's interesting, and that is somewhat innovative, I think. Now, another thing that's innovative is to have your own private foundation. And I strongly disagree with many of the speakers and authors who say, well, if you don't have at least $5 million, you can't afford to do a private foundation. It's so expensive and it's so difficult. And I just think that's not the right approach. It should cost about $2,500 to set up a private foundation or a private operating foundation, plus the expense of filing a Form 1023, which might be another $1,000 or $2,000, and then you may have a $500 IRS filing fee. So this may cost you $5,000. This should not cost $50,000. So what we like to see is a family that tries the foundation on for size and decides whether they like the idea of having their own philanthropy organization. Now, if you don't even want to spend that kind of money, the next thing you can do is what we call an incomplete gift charitable foundation. I could form the Alan and Marcia Charitable Trust, that's its name, but not register it with the IRS and not get 501c3 status and also have the right to get all the money back. And we could put $20,000 in that organization, and we could explain to our daughter and our granddaughter that we put $20,000 in this and that it's up to them to decide how to spend it for charitable purposes. And when they actually spend it, then we'll get the tax deduction. But we've set up the organization. Now, often this works well just before a new marriage or just before a new relationship. For instance, I had a client who had pledged $500,000 to his college, and his net worth was $3 million. And he was about to get married again. And he wanted to make it very clear to his new bride that this $500,000 was going to the university unless he desperately needed it. So we put it in an incomplete, irrevocable trust that benefits only him and the university. And that way, he's not able to take it out and spend it on anything other than himself or the university when the rest of his assets run out. So that way, he did not get the tax deduction, but he made the point very clear, and the university was very thankful. And they also know they need to behave, because if they make him angry, he can change the beneficiary of the trust. So you can think about that. He liked the idea. He liked where it was going. So he did come back to me later and said, let's go ahead and make this into a private foundation so I can get the deduction now and lock it in for the charity. And we did that. So there are two types of private foundations. The first type is the private non-operating foundation. The private non-operating foundation, you can put money in, and you can put up to 20% of your adjusted gross income in non-cash assets. The deductions are not as good as with a private operating foundation, because with a private non-operating foundation, which basically receives money or other gifts from you and then doles them out to charity later, you can only deduct your income tax basis in assets that you give to that foundation. So if I have IBM stock, I paid $100,000 for it, it's worth $1 million, I put it in my private non-operating foundation, I only get a $100,000 tax deduction. But if my private foundation operates, if it actually conducts some charitable activities that qualify it as a private operating foundation, then I can deduct the $1 million value of that stock, and I can write it off against up to 30% of my adjusted gross income. So if my adjusted gross income is $1 million a year, then I can write off $300,000 a year. If I put $1 million worth of stock in this year, I will get $300,000 deduction this year, $300,000 the next year, $300,000 the next year, and $100,000 the final year for having locked in that donation. So that is the private operating foundation. What does it have to do to operate? Well, a good example that many clients have enjoyed using is scholarship funds. If my daughter charges me $100 an hour, and she's a licensed psychologist, and she collaborates with my favorite charity to find people who would like to be better educated and licensed, I can introduce her to my local hospital foundation board, They can introduce her to employees of the hospital who would like to become registered nurses. She can interview them. She can mentor them. She can choose who gets the scholarships. She can write them the checks to write to the college and to buy them the books. She can then check on them annually, and we can give them awards, and we can even help them find jobs. That would be a private operating foundation. Now, let's say that I have a building that we lease out that is worth $1 million. It's been completely depreciated, taking straight line depreciation. And I would like to get credit for donating that building to the local hospital. I'd like my name on a hospital floor or a hospital lobby. So, and I have a niece who manages that building that I pay a management fee. And I don't want to part with the building while I'm alive. So I put the building in the private operating foundation. I get $1 million tax deduction. My niece continues to manage the building. She gets her management fee. My daughter uses the money from the rent to pay for scholarships and to pay my daughter. I still feel like the building is mine. There's now no income tax paid on the rent because 501c3 organizations can receive rent income tax-free if they follow the rules, and I get a $1 million write-off after I've already taken $1 million of depreciation over the past decades. So that is an example of a happy story, and the agreement can provide that upon my death, the building will pass from my private operating foundation to the hospital. So that's why the hospital will give me credit for the donation. So not only is Uncle Sam going to pay for 40% or whatever it is, depending upon your state taxes, of the value of that donation while I'm alive, but they're going to give me valuable recognition, which may cause people in the community to be more likely to buy my products or to buy my services. So it all comes back around. And with a private operating foundation, I get all of the same donation rights that I would have with a public charity. I can get up to 30% of adjusted gross income, write off for donation of appreciated assets that qualify, and then I can put another 20% of adjusted gross income in cash any year I want to do that. Now, also make note that the ability to take $100,000 out of your IRA and to transfer it into a charity if you're over 70 and a half, so that you don't pay any money on what your minimum distribution would have been. It just passes up to $100,000 directly to charity. That can go to a public charity, or it can go to a private operating foundation. So I could be moving $100,000 a year out of my IRA tax-free into a private operating foundation that would pay my children and grandchildren to do sincerely charitable things. But something else that's more exciting through the end of 2021 is that any taxpayer over 59 and a half can withdraw as much money as you want from your IRA, pay no excise tax because you're over 59 and a half, and then donate that money to the charity of your choice, and you will get a full deduction. Because in 2021 and 2020, the adjusted gross income for a cash gift is 100%. So in other words, if I earn $1 million this year in adjusted gross income on my tax return, and I take $1 million out of my IRA, and I move that $1 million by donation to a private operating foundation operated by my children, then I get the full donation. I don't have to wait to die to do that, and I'm not limited to $100,000 a year. So your clients who have been doing it to the tune of $100,000 a year need to make sure they know that it's really unlimited this year. There's a little bit of a tiny calculation you need to do because of the standard deduction. There might be a couple $1,000s of the deduction lost, but that's the way that it works. So strongly recommend that you review this information with your advisor. Now, if you're only donating so much, you may not want to donate this year because the chances are you'll be in a higher tax bracket next year if you make more than $400,000 a year. So that's another consideration, whether to do it now or to wait. Now, something else that I want to mention is there's usually two reasons that clients would rather be involved with a public charity than a private operating foundation. The first reason is with the private operating foundation, you have to spend at least 4.25% of the value of the assets of the foundation every year on legitimate charitable expenses. So in my $1 million building example, that's $42,500 a year that is awarded as scholarships. In addition, with a private operating foundation, other than paying yourself reasonable compensation or providing the private operating foundation with interest-free loans or interest-free leasing opportunities, you can't do business with your private foundation. You can't sell its assets, you can't buy assets. But with a public charity, you can do transactions. And with a public charity, there's no annual minimum distribution amount. So why or how would you get a public charity? Most public charities qualify because either more than a third of the donations come from donors who do not donate more than 2% of total and are not related to anyone who donates more than 2% of total. So you would have to have a lot of small donors. The alternative is that 66% or more of your donations plus receipts from charitable purposes come from the general public. And those are difficult to reach. But there's 4 other categories that are public charities, even though your client is the sole donor and the sole controller of that entity. These are medical clinics that reach the definition of what they call a hospital, medical research organizations, and a lot of doctors have a lot of grants going, and get more grants and more research projects if they're a 501c3. The third category is a church, synagogue, or mosque or other house of worship. So those are the categories that your client may be able to reach, especially, and the final one, the fourth one, which is the most common, is a school. And a school is a place, a physical location with a physical address where teachers teach one or more subjects to students. It could be a karate school, it could be a swimming school, it could be a day school, and that will qualify as a public charity. Now, in order to give public charity status, the IRS informally requires a board of directors beyond just the donor. But if you start the organization as a private operating foundation, they will approve you as a single donor in complete control. And then if you convert later from a private operating foundation to a public charity, they, by practice, will not require that you have more people on your board than just the donor, or that the donor can replace anyone on the board with anyone else who the donor decides is appropriate. So this is why, for example, Mr. Pointner, who used to own the St. Petersburg Times, died and left the St. Petersburg Times to a charitable organization called the Pointner Institute. And the Pointner Institute is a school of journalism located in St. Petersburg, Florida. So it is a public charity. It has no obligation to do anything but operate its school. It's okay if it breaks even. It doesn't have to lose money operating the school. There are many charter schools in Florida. In Florida, if you run a charter school, the government will pay you $6,000 per year per student for first grade through 12th grade, whatever grades you like. You could actually break even. You could actually make a little bit of money. And then that school can own what you donate to it to get an income tax deduction with no minimum distribution requirement. The other ways around the 4.25% minimum distribution requirement is it only has to happen 3 out of 4 years. Most people don't realize that. And if you buy a break-even charity or you open a break-even charity, the expenses of the charity will count towards that. For example, I had a client with $50 million in his private operating foundation. So 4.25% times $50 million, over $2 million a year. Well, we found a charity that had $3 million a year of receipts and $2.5 million a year of expenses. So he adopted that charity. He brought it into his private operating foundation. His private operating foundation runs that charity at a $500,000 a year loss. But all those expenses that it pays to generate that loss are counted towards the 4.25%. So by having credit for all those expenses, he doesn't have to distribute nearly as much as 4.25% of the value. The second way around the set aside is to earmark money for future projects, especially if you're going to build a building for somebody or a build out of some kind. All you have to do is tell the IRS, I'm putting this money aside. It's in a side fund. I'm going to spend it within the next 60 months on doing this and that. And then you don't have to make the distribution. And then if the building you build is used strictly for charity, then the use itself counts, so you don't have that issue. So I hope that those are all helpful for those of us who represent clients who would otherwise be more charitable if they didn't know their way around these common objections that we see. Now, when I switch to Brandon, he'll be talking about the flip NIMCRUT, but I want to plant the seed now. You are a client and you're about to have a beautiful, wonderful liquidity event. And your liquidity event is the sale of a big piece of property that had straight line depreciation or your business. And you're not so happy about paying the capital gains tax. You don't really want to do a 1031 exchange of real estate if you're selling real estate. You've heard that qualified opportunity zones can help you reduce capital gains taxes or defer them, but everybody and their brother has bought into qualified opportunity zones, so they're overpriced. Well, you can defer the tax and get an income tax deduction by placing the asset into a charitable remainder unit trust before it's sold. And then the charitable remainder unit trust sells the asset, and you don't pay any tax until you take the money out of the charitable remainder unit trust. And if you do this properly, you don't have to take a dollar out until year 14, unless you want it. So the income builds up inside the charitable remainder unit trust. And if you want to get the maximum amount out of the unit trust with the minimum amount going to charity, you don't take anything normally until year 14. In year 14, you take a bunch out. You pay a lot of tax or you give the money to charity. Depending on where you are in 14 years, you can decide in 14 years. And then in years 15 through 20, you take out pretty much a lot every year. The charity ends up with usually 8 to 10% of the total amount at the end, but the charity can be your family private operating foundation that you set up in year 14. So the charitable remainder trust can own real estate, and you would put the real estate into the charitable remainder trust before there is any contractual obligation to sell the asset, or you would put the real estate in whole or in part into a private operating foundation before the sale, not after the sale. Why? If I sell it and I put 10% of the sales proceeds into a charity, then I only get a deduction for the amount I gave the charity. But if I give 10% of the building to the charity before there's a binding contract to sell it, I get a tax deduction for 10%, and I don't have to pay income tax on 10%. So I actually have the equivalent of a 20% deduction. And we have some numerical examples there. But when the client comes to us and says, hey, I've got a great deal. I mean, I'm in the letter of intent stage. I want you to review the contract before you sign it. Would you like to give a little bit to charity at the end of the day? Yes. Would you like to have a big income tax deduction and a lot of recognition? Yes. Well, then let's go ahead and donate this early rather than later. Which brings us to an example. And the example is, I have a company worth $3 million, and it's going to sell maybe in a year or two. So I sell the 99% voting stock, non-voting stock in the company to a dynasty trust for my children for a $2 million note. It's out of my estate now, and I'm considered to own the dynasty trust for tax purposes. And many people on this webinar have done this. I know who you are. You're our clients and friends, and you now have a dynasty trust that owns this appreciated asset. And then now you're about to sell the company from the dynasty trust. The dynasty trust forms the charitable remainder unit trust, and the charitable remainder unit trust receives part of the stock, and now the sale takes place by the charitable remainder unit trust, and there is no income tax at the time of the sale, or whatever portion goes into the charitable remainder unit trust, and you get the tax deduction. You personally get the tax deduction, not the dynasty trust. So, we find that things like this are very, very interesting and very, very rewarding. I'm going to go ahead now and show you something else that we've been, very fortunate to learn about and very fortunate to be able to put into place with some numbers that made a big difference in a lot of lives, quite candidly, from a charitable standpoint. And that is, you can donate non-voting stock in a C corporation to a private operating foundation and keep control over the stock and keep part ownership of the stock by putting the 1% voting into an irrevocable trust that is 35% for the family and 65% for non-family, non-related, worthy causes, not necessarily charities. There is an express exception in the self-dealing rules for this kind of trust. And I can hardly read it, but it's under code section 4946A1G. 4946A1G is the Internal Revenue Code section of the day. That says that I can put my 1% voting stock in a trust that's 35% for my family, 65% maybe for cemetery associations and police benevolent associations, which are entities that are charitable but don't qualify for a charitable deduction. There's a reason that I would want to do that I won't go into. And then maybe I'll keep 79% of the company non-voting, and I'll donate 20% of the company or 25% of the company non-voting to my private operating foundation. And I'll give my private operating foundation the right to be bought out for 20% of the value of the company. So even though it's non-voting, I would expect a charitable deduction for 20% of the value of the company. That will save me a lot of income taxes, but allow me to work with a private operating foundation to get that deduction, and I control the private operating foundation. Now, I cannot deal with the private operating foundation other than to control it for charitable purposes, but I can deal with the C Corporation, LLC. So that is an example of when you have a client who says, well, when I die, I'm going to leave the whole thing to charity. Well, would you like to give it a little bit to charity while you're alive to have Uncle Sam give you a beautiful, wonderful income tax deduction? Yes, I would. Well, this is the way to do it. And we have an article called The Donor Controlled Business Entity, which goes into a lot more detail. Now, after I do this or before I do this, my private operating foundation may become a public charity by operating a school. And so that would be, you know, a really good cause and can do a lot for the community. Now, I have page after page of other ideas, and I'm just going to take you through a few of them. And then I think we'll need to do a part 2 of this, or we'll have to do at least a hybrid of some of the other things I'm not getting to. But have a party for charity, especially if your spouse is not as charitable as you are. Go ahead and have a party for charity. The charity will either reimburse you for the party if you ask them to, or what you pay for the party will be a deduction. And you'll find that the charity will raise about as much as you spend on the party, but the charity will receive many more in donations because of the relationships it will form with your friends and with your family and with your colleagues who you can invite to the party. And if it's open bar, you can invite me as well. Now, in addition to that, take your old jewelry and give it to charity, because if the jewelry is used by the charity in a display case, then you can deduct the fair market value of the jewelry. Now, you and I know that used jewelry is worth probably 20% of what you paid for it. And someday your grandchildren are going to hawk it for 20% of what it's worth. But if you give it to a charity, you are allowed to deduct the fair market value based on what a retailer would sell it for. And used jewelry at retail will typically sell for 60 to 70% of what you paid for it. So it's not a bad thing, and especially if you want to buy new jewelry and replace it to replace the old jewelry, the donation is actually a pretty good deal if you're in a high tax bracket and you're doing a nice thing for the charity. If you are a professional and you get into monetary disputes with clients, suppliers, whatever they are, offer to settle the dispute by giving to charity. Look, we're at $5,000 apart. Just donate the $5,000. I think you owe it to me. You think you don't. Donate the $5,000 to any of the following 4 charities, and you can get the credit as the donor. So, for example, Marcia and I like to donate a certain amount every year to charity. Now, I can meet that goal by donating my own money or asking my clients to donate their money. So it's a feel-good type of thing to settle disputes or to even settle business deals. Like, you know, you want an extra $10,000 for that property. I'm only willing to pay this much, but if you name a charity, any of the following 4 charities, I'll give that money to that charity. You give me the house that you're selling me for $10,000 less than you wanted. And that can be a really good way. And I thank attorney Joel Bronstein for teaching me that about 20 years ago, because a lot has gone to charity from client disputes that we got resolved by charitable donations by people who, when you ask people to take the high road, they will often take the high road. Another idea, when you buy a property that has an old house on it, allocate as much as you can to the old house, and then have somebody pick up the house physically and take it somewhere for a charitable use. I've had clients buy old houses on the water, antique houses on the water. Then you put the house on a barge, and the barge takes it to a charity that's also on the same body of water, and then you get a deduction for the value of the house, and it feels good as well. One client did that for an orphanage, and he got a $300,000 refund from the IRS because of the tax deduction, and several children still live in that house. It's a orphanage at the Florida Sheriff Boys Ranch. So I think it's the Boys and Girls Ranch now. It was just the Boys Ranch when I was there. Another way to get a tax-free check from the government without having to write a check to a charity is donate the remainder interest in your home or your vacation home or in your farm to the charity of your choice. And you get a tax deduction now for the fact that when you die, that home or that farm will then pass by remainder interest to the charity. So people like that idea. They know they want the house or the farm to go to the charity, but you can get a check today for the promise legally enforceable made. And then we find from experience that most clients later on in years go ahead and give the life estate to the charity and get the deduction. Okay, the one last thing that I'll mention before I hand this over to Brandon is don't leave it all to charity. Now, what do I mean by that? I have a client who wanted to leave it all to charity, and he has some S corporations. And S corporations do not go well with charity. And the reason is that because under the unrelated business taxable income rules, every dollar of earnings from S corporation K1 income is taxable to the charity. And if the charity eventually sells or redeems the S corporation ownership, it pays tax on that. And if a charity gets too much unrelated business taxable income, it loses its 501c3 status. So I said, look, you know, you have an $11,700,000 estate tax exemption. So when you die, let's leave $11,700,000 worth of S Corp stock to a non-charitable trust. So a non-charitable trust would be what we call a complex trust. And a complex trust can receive income and pay it to a charity and get a deduction for 100% of the payment that it makes to the charity. So he can die. We can put the S corporation stock into the trust, and if the S corporation stock throws off $2 million of K1 income, and he gets $2 million of cash into the trust, now the trust can pay $2 million to the private operating foundation that he's going to be leaving, and we'll pay zero tax, and we can retain all of that S corporation stock. And by the way, he would also like for his managers to be rewarded for doing a good job. And he would also like some of his ex-employees to have scholarship, educational, and retirement benefits, which you can't do from a charity, because a charity cannot be for ascertainable people. So this $11.7 million that's going to go into this trust, which is going to hold the S Corp stock, is also going to be able to give incentive payments to his managers, which will not challenge the 501c3 status of the private operating foundation or public charity that he's going to be leaving, and can also pay educational benefits and retirement benefits to these ex-employees who have been so loyal, who he would like to benefit. And we can leverage this. So for example, if the 11 million, if he has $20 million of S corporation stock, then on his death, we can have the $20 million of S corp stock go into the non-charitable trust, and it could owe a note for 10 million to an LLC, and then the non-voting membership interest in the LLC can pass to the charity according to many private letter rulings that have been issued. This chart is not exactly what I just said. This chart shows another technique that may be of interest, but you know, honestly, it took some sitting down, it took some thinking, it took some brainstorming with lawyers who specialize in this area to get to the best result for this client. Now, let me mention that the IRS for many years has been issuing rulings which say that if you take a promissory note owed by a trust that you're related to, you put that note in an LLC, and then you give a non-voting membership interest in the LLC to a charitable organization or a charitable lead annuity trust, then that does not violate the self-dealing rules. Well, the IRS this year has announced that they're no longer going to give rulings to that effect. It's on the no ruling list, which means they may begin questioning these arrangements, just so you know. The other thing I'll point out from this chart is if the client does have family members that they would like to benefit, then they can get a 100% estate and gift tax deduction by leaving these assets or giving them during lifetime to a charitable lead annuity trust, which makes a stream of payments to charity, with the remainder interest going to non-charitable purposes, which could be that non-charitable trust. So there would be no estate tax on the client's death, a lot going to a private operating foundation or public charity over a series of years, and then the rest going to the complex trust. And while you're thinking about the complex trust, if the client wants to donate more than 50% of adjusted gross income to charity, go ahead and put an income producing asset into a complex trust. The complex trust can get a 100% of income deduction for the assets going to charity, and the complex trust may come back to the family later on. So I think that that is all I can cover, giving you some time to watch Brandon's excellent presentation. We will be checking our emails and looking forward to any questions, comments, or suggestions that you might have. Our next presentation in the charitable world will be more about charitable lead annuity trusts. I think I'll ask Jerry Hesh to join us. And now let me see if I have graduated technical school to the degree that I'm able to actually show a video during a video.
Okay, so Alan just wanted me to hop on and talk a little bit about charitable remainder trust and how those work and the different options that you have with the charitable remainder trust. So essentially what happens here is you would place assets into a trust. The income tax would be tax deferred until the assets are distributed from that trust. And then you would have a set term of years or a lifetime payment period where distributions are made from the trust to a non-charitable beneficiary. And at the end of that term, whatever is left goes to a charity. So that's why you get the favorable income tax treatment. It's not technically a tax exempt entity, but it's more of a tax deferral entity. But the income tax benefits can be pretty nice by spreading out income over a number of years. So when you contribute assets to this trust, there are certain rules that you have to follow. Basically, you have to set the payout percentage so that, at least according to the IRS, the actuarial expected value based upon present value factors that the charity is expected to receive at the end of the term has to be at least 10% of the assets going into the trust. So if you contribute $1 million into the charitable remainder trust, whatever the payout percentage is, whatever the term is, what is expected to go to charity would have to be at least $100,000. Now, that doesn't mean the charity has to actually receive that It's just that's the expected amount based upon how the IRS tells us we have to calculate these. So a couple of different options here. You can have a CRAT, which is a charitable remainder annuity trust, where you just have a fixed dollar amount each year that comes out of the trust to the non-charitable beneficiary. At the end of the term, whatever's left goes to charity. So it might be a 20-year term where you would have $100,000 going in, $5,000 a year comes out for 20 years, and then whatever's left at the end of that term would go to the charity. The benefit there really for if the assets are appreciating inures to the charity because that dollar amount is going to be flat. Now you could also do a charitable remainder unit trust where you pay out a fixed percentage of the value of the trust each year. So that way, as the assets grow in value, the unit trust payment also grows in value. So the benefit then inures to the non-charitable beneficiary. The percentage of payout for the CRUT has to be at least 5%, and it can't be more than 50%. And then you also have to satisfy the rule that actuarially the expected value going to charity is at least 10%. So a variety of different payout methods that you can use. This can be based upon a term of years for all the way up to 20 years is the maximum term of years. You could base it off the lifetime of yourself, the lifetime of another, multiple lifetimes, so a joint life expectancy, a joint and survivor CRUT would work. You could also do for the longer of a term of years or a lifetime payment, or the shorter of a term of years or a lifetime payment. So a lot of flexibility as to how you want to structure it, and depending on the results you would like to receive, you can structure the NIM CRUT or the CRUT in that way, and we'll get to some of those different scenarios in a minute. Now, as far as the income tax treatment goes, as the assets go in, there's no tax as they earn income until the assets are distributed. And it carries out the income on a worst first basis with those distributions. So if the trust has ordinary income that's been built up inside the CRUT and not distributed, that ordinary income comes out first, followed by capital gains, followed by maybe principal is the last. So there's different tiers of income that comes out. Ordinary income, maybe depreciation recapture at a 25% rate, a capital gains rate, and then principal. You also might have 199A income layered in there somewhere. That is another tier that's just recently developed as a result of the passage of the Section 199A 20% qualified business income deduction. Now, we did talk about the deduction, or at least the actuarial value of the remainder interest has to be at least 10%. And because of that actuarial being expected to go to charity, you get an income tax deduction when you contribute assets to the trust. So not only do you get the benefit of tax deferral, you also get the benefit of an income tax deduction. So how can this be structured? We mentioned there's different flexibilities. So you could do a term of years, and here are the percentages based upon those terms of years for a charitable remainder unit trust. You could do it on the life of two people. So two 40-year-olds, 5.13% would have to come out each year to maximize the value coming back out and minimize what's going to charity to just 10%. So you can see where we can run into issues where you can't satisfy that the payments have to be at least 5% each year, and all the way up to 50% each year is what the CRUT percentages can be. You can do it on the life of three people, but again, you might run into issues where you cannot get at least 5% out and leave at least 10% for charity in those situations because of the long life expectancies of the life of three people. So interesting that you can do this not only for one person, but multiple lifetimes or terms of years. So a lot of flexibility in how the payout structures work. So practically, how can you use a charitable remainder trust? Well, one of the most common tools is really just to defer income out over a number of years. And this could become important, particularly if we run into compressed income tax brackets, or if we have a surcharge on adjusted gross income like has been proposed. So if you have AGI of greater than $5 million, there's a proposal out there that would apply a surcharge of 3% an excise tax on income in excess of that amount. So one thing you could do is if you're expected to sell a business for a large gain, you put it in the charitable remainder trust, you sell it under the charitable remainder trust, and then you spread that income out over 20 years by distributing X% each year from the charitable remainder trust and recognizing the income as it's distributed. So it almost works in equivalent to like an installment sale in a way, where you can just spread out income over a number of years. So we might see charitable remainder trust used for that purpose coming up. One thing that we've done for a recent client is he came to us with the idea of he wants to give $100,000 to each of his children, but he didn't want to give them $100,000 outright. It wanted to be structured in a trust where they would only get a certain percentage each year, and they could control and manage the investments. And he wanted to provide them with a benefit to where if the investment assets grew, the amount that they got would also increase, to just introduce them to how to manage assets and how to be responsible. So we recommended the charitable remainder trust in that situation, because then he wouldn't have to tell them that I drafted this trust that restricts you from receiving assets. He could tell them, this is a requirement of the trust to have this type of structure and to give, the type of benefits that I want to give to you. So what we did is we gave him different options. So there are the ages of his kids: 50, 55, 40, 48. So we said, look, you can maximize the charitable deduction benefit, or sorry, maximize your benefit to where the minimum amount's going to charity based upon the lifetime of the beneficiaries. So a 55-year-old would have 11.84%. A 50-year-old would have 9.64%. The 48-year-old would get 8.96%. The 40-year-old would get 6.92%. The other option is maybe you just equalize the amount and you get 6.92% for everyone each year. And in that situation, here's going to be the value of your charitable deduction. Obviously, since we're below the maximum amount for the 55-year-old, that charitable deduction, so the amount that's expected to go to charity, increases. So he gets the $21,000 deduction there. Or we could just do a 20-year flat term. Everybody gets 10.8%. You get a $10,000 charitable deduction for each contribution. So this worked out well. The client liked it. The kids liked it. They got a nice benefit and the ability to manage and control assets and receive stuff back each year that they could spend for living expenses. Now, another interesting one is the flip NIM-CRUT. This gets a little bit more complicated, where you base the language of the CRUT to say, instead of just automatically distributing out 6% each year, or whatever the percentage might be, the CRUT will distribute out the lesser of its net income, or the 6% per year payment. And the benefit there is, if the trust doesn't receive any income, then it doesn't pay anything out. So all that income remains in the trust and is deferred all the way up to what the 20-year term, if you want it to be that way. So how do we control the income? How do we block the income? Well, to measure the income, it's based upon fiduciary accounting income, which is different than taxable income. And under the Fiduciary Accounting Income Rules, which are state law based upon the Principal and Income Act of the applicable state where the trust is situs, most states provide that if you have an entity, then the entity blocks the income, and income is only received by the trust when a distribution is made. So you take your income producing asset, you put it under an LLC that is owned by the Charitable Remainder Unit Trust. When you want to make a distribution out of the Charitable Remainder Unit Trust, you make a distribution from the LLC, which triggers income, which then distributes out amounts to the beneficiary. The benefit of the NIM-CRUT too is that each year, whatever payment that was supposed to come out, so if it was a 6% unit trust, that's stored and banked in a makeup account, and it's made up in future years when the income is sufficient to trigger up that makeup account. So if we wanted, let's go through an example where we have $100,000 in the CRUT, there's no income, so $6,000 would be stored in a makeup account to be distributed in later years. In year 2, there's still no income, so another $6,000 goes into the makeup account. So now there's $12,000 sitting in that makeup account. And then in year 3, we make a distribution from the LLC of, let's call it $18,000 to make the numbers work out. So the distribution would first satisfy the 6% payment that's required to be made this year. And then, since there's still income left, it can look back to the makeup account and go ahead and distribute out the full makeup account as well, to satisfy what should have been paid out in former years when there was no income. So it's a nice way to really control when income comes out and when it's taxable and when the non-charitable beneficiaries get the benefit. Now, the flip, what does the flip mean? you can have the ability to have a triggering event which would convert the NIMCRUT, the net income with makeup charitable remainder unit trust, into just a normal charitable remainder unit trust, where it would just pay 6% or whatever the percentage is each year, regardless of the level of income. The benefit there is you might run into situations where the State Principal and Income Act doesn't allow you to make a large distribution. And if you make a large distribution, it might be deemed principal in later years. And therefore, you can flip to a regular CRUT, just distribute out the 6% and kind of dip into those last remaining principal amounts in the final years of the charitable trust. So a couple of different triggering events that can occur here. We have them listed on slide 13. Divorce, marriage. The one that we like to use is the sale of a non-marketable security. So you have the CRUT just own an LLC interest, and whenever that LLC interest is sold, it can flip to a regular CRUT to just provide the flexibility. So what does this structure look like? Here is a chart of one that we have done for a client. We have ABC LLC down here. It was expected to be sold for a large gain. So well before the sale occurred, well before we had a binding sale, we set this structure up. Fortunately, it was all under a dynasty trust, so we didn't have to worry about estate tax issues. All outside of his estate. The dynasty trust specifically allowed for the curation of this NIMCRUT, so we didn't have to worry about fiduciary issues or gifts by beneficiaries. So we had the dynasty trust set up an LLC to form the alpha and beta flip NIMCRUT. They formed a partnership with the two of them as the blocker entity, and then ABC was held by this blocker entity. So ABC sold for a large gain. There was, let's call it $20 million of income on the sell. So instead of the income all flowing out to the grantor of the dynasty trust, it was held up here under the NIMCRUTs. So it's all sitting in this blocker entity. It's all invested in the market in marketable securities now, and no income has come out for the last 4 years. Now, if they do want to get income, they simply make a distribution from this blocker entity to one of more of the NIMCRUTs, and then that triggers the income under fiduciary accounting law, and then the trust would then distribute out whatever's in the makeup account and whatever percentage should have came out in the current year to the LLC, which can then flow up to the dynasty trust and out to the beneficiaries. We also have the non-marketable security here owned by the NIMCRUT, so if they ever wanted to get away from worrying about net income, or if they just wanted to flip to a regular CRUT, simply sell this LLC, and that triggers the conversion to a regular CRUT. So what about numbers? How does this work out economically? Well, we ran some numbers on this, and in this scenario here, we have the NIMCRUT. And in this scenario, we said, they're going to allow 1% to come out each year, even though the trust distribution percentage is around 10%. We're going to keep the other 6% invested in the blocker LLC and not trigger that until the last year of the NIMCRUT. So we put $1 million in. We only had basis of $200,000 in the asset. It's sold, which would normally trigger $800,000 of capital gain. But in this case, it's all deferred under the NIMCRUT until it comes out. So in year one, we had a 1% distribution, $10,000 comes out. You pay taxes on that amount. The net goes to the family. And that's just stored over here in an account that grows at 6%, so we can annualize the numbers and then see how it turns out at the end of the 20 years. By putting that money in, that $1 million, the client received a charitable income tax deduction of $100,000, which resulted in a benefit in dollars of around $52,000 based upon their income tax rates. So then each year, 1% comes out. The remaining stays into the charitable remainder unit trust. And then in year 20, we make a large distribution from that blocker in LLC, triggering the makeup account, triggering the distribution. We do have a large gain at that point in time, but we have deferred that over a long period of time, 20 years, so the client can save money and be prepared for that. And so then the charity got around $240,000 and the client got around $3.1 million in total after the 20 years. So how does that compare to other scenarios? Well, if they just sold the asset, invested the $800,000 in the market at the comparable rate of return, they would have only had $2.6 million. So the tax deferred growth here actually gives them better off, even though a small amount goes to charity. What if they put the money in an account and then tried to make charitable deductions each year so they could have the same charitable benefit, but also not have to worry about the NIM-CRUT structure? Well, in that scenario here, only $2.4 million. So you can see the difference that the NIM-CRUT could make. Even though amount goes to charity, we get a nice benefit to the family. How does this compare to just a regular old CRUT? Well, when we look at this, you can see here that the NIM-CRUT and the ability to defer the assets and wait until the final years of the trust to distribute that, let it all grow tax-free, has a nice benefit over using a regular charitable remainder trust or just no planning at all and investing and paying taxes as you normally would. So what are some other benefits here? Well, with the change in the IRA distribution rules to say that everything has to come out within 10 years, a lot of people have proposed using a charitable remainder trust to try to mimic the life expectancy payouts of the stretch IRA. So you would have the IRA payable to a charitable remainder trust, which would make payments out over a beneficiary's lifetime. And then a small amount would go to charity at the end of the years. So we ran some numbers, compared that. What if the assets come out under the 10-year rule versus what if we have a beneficiary of the IRA be the charitable remainder trust, which would then distribute assets out over the lifetime of the child. So under the 10-year rule here, we have the IRA balance growing tax-free at 7% for 10 years, and then distributed out to the beneficiary, large income tax payment. The net to the beneficiary there is around 1.2 million. He invests that money at 6% growth, and at the end of 20 years, there's $2.2 million in this account balance, assuming that he doesn't spend it all. If we have a charitable remainder trust, 20-year term, so try to mimic the life expectancy payout of the child, 10.87% comes out each year. At the end of the 20-year term, $450,000 goes to charity, and 1.9 goes to the beneficiary. But instead of getting a large lump sum payment at the end of 10 years, he's got a nice benefit of around $100,000 each year for 20 years. So it's not quite as good as the 10-year rule, but some clients prefer it just because the beneficiaries get less money out. It's more controlled, and it can work out well to try to mimic those old stretch IRA rules. So that's the stretch CRUT for use in an IRA. So just wanted to cover that briefly. And we have some other slides comparing the accumulation trust where we have the 10 years, and then the charitable remainder unit trust where the IRA is left to the CRUT. So Alan, I'll kick it back to you now and let you continue with the show, or maybe this is the end of the presentation, and if so, I hope everyone enjoyed it, and feel free to email any questions that you might have to me or Alan. My email is Brandon, BRANDON, @gassmanpa.com, and we'll try to answer the questions that you do have. So thanks very much for listening. Alan, back to you.
All right, well, Brandon, I thought you did a great job on that, and I hope you're enjoying your time away. This completes our presentation. I just want to share 3 book suggestions for you. I spoke recently to a Stetson Law School Student Association, and I proposed that they start a book club and that they just spend 15 minutes every week on one book. And one of the books that I'm suggesting for them is by Dr. Stephen Post, and it's Why Good Things Happen to Good People. It's not the same series that Rabbi Kushner, I think is his name, writes, which is why bad things happen. Dr. Stephen Post is a university professor, and he has engaged in several studies to look at the health and financial results for successful people who are charitable compared to the health and financial results of successful people who are not charitable. And what he has found, and what many clients have told me, is that they didn't really break through in their businesses or their self-confidence until they started being charitable. And that the more they give of their time and their money to charity, the more successful they are, because they feel that the universe repays. And as to the health aspect, I have not seen any studies on that, but I can tell you that clients who are charitable tend to be happier, and that my most charitable clients have all lived to their 90s. So I'm sure there's exceptions to the rule, but the main reason that many of us give is because we feel good. It makes us feel good. So this is a great read for you and for anybody who's interested in giving. Because I tell my clients, if you give, you feel better, and the universe may reward that. Now, two other books that we could talk about sometime. A very, very good one by Marshall Goldsmith, which is What Got You Here Won't Get You There. So as so many people are successful in their business, they change the way they act, and maybe are not so nice to everybody as they could be. And so this is a great book to determine if you have become a jerk. And if you have become a jerk, how to stop being a jerk. Just a great book. And then the last one I wanted to mention, which was given to me by a client. I actually saw it in his office and I asked about it. And it is the no complaining rule. It runs parallel to the Dale Carnegie book that one of the early chapters in How to Win Friends and Influence People, which says never complain or disparage. So this is a really nice, easy story to read. It's an interesting story about a lady who has a health problem and business problems and how she handles them by learning to never, ever complain. There's a big difference between offering suggestions for improvement and complaining. So we bought this book for all of our employees, and it's really just an excellent, simple one afternoon read. The testimonial here, Get Off the Complaint Train and Read This Book by Ken Blanchard, who wrote the 1 Minute Manager, which is another great book that I can recommend. So I hope that you've enjoyed the presentation. Again, I thank Brandon. I also thank some lawyers named Carl Mills, Eric Dryberg, and Michael Lehman, who have taught us a lot of what we know in this area. Please feel free to share this webinar with anyone you like and even people you don't like. Let us know future suggestions, send us any questions, and have a fantastic rest of your day helping others. Thank you.